Hello, everybody. This is Les Solgrove from Simply Des Moines, Market Values month of April, end of month report. It's Sunday, May 5th, and I'm coming to you tonight from Washington, D.C., and this is a special report. We're going to talk about the end of April report, and then next week the show will highlight some events that maybe have happened in the Washington, D.C. NAR meetings out here, and also catch back up with what's been happening on a weekly basis here. So, as always, you can find all of the graphics and the videos at DesMoinesMarketValues.com. And do me a favor, if you would, hit the thumbs up button, give me a like, and also share this video with your friends. This is always good for everybody to share this out. It helps get the message out. So let's get started. So last week, the Federal Reserve had met again. They've had six consecutive meetings so far this year with no action taken. Actually, six consecutive meetings since August of last year with no action taken as far as raising or lowering the Federal Reserve borrowing fund rate. It's currently sitting at 5.5%, and we're continuing to see that. And the message from Fed Chair Powell was that it's unlikely that we're going to see a policy rate move that's going to go up, which, okay, that's okay. We don't want to go back up anymore. But the important thing is to listen to what he's not saying, and that is that they're not anticipating a reduction anytime soon either. So late last year and early on this year, we were talking about how perhaps the Fed rate was going to go down with two or three drops throughout the year. And it doesn't look like that's going to happen, if at all, maybe one time, and that'll be maybe closer to the end of the year. So what you can see here is that mortgage interest rates this past week, the 30-year fixed rate from the Federal Reserve average actions puts the current mortgage rate for a 30-year fixed rate at 7.22%. That's the highest we've seen since probably late October, early November of last year. And so what does that mean? This is obviously it means that the buying power continues to remain lower than in previous years. You can see from 2023 to 2024, it's been fairly stable, but it's also about $100,000 lower than the peak from 2021 to 2022. And so that's one of the factors that's maybe keeping some of the home buyers from being able to afford some of the higher price points of inventory, and maybe keeping some home sellers that maybe would be on the market, keeping them from coming out and entering into the home selling market as well. So that was going back to 2019 or 2018. So let's kind of look at this week over week, the buying power from just 2024, comparing it to last year. And you can see just basically, again, we are in a little less buying power position than we were a year ago. And that's going to be true until this bar chart here actually goes above last year's numbers. And hopefully we'll start to see some stabilization and a little bit lowering of mortgage interest rates. But we might be in this close to 7% rate number here for some time to come. So again, at least it's stable. That's all we can say about that. The mortgage inventory, or I'm sorry, the mortgage interest rates and then the home inventory, both are continuing to rise. As you can see, this is from 2023 to 2024. And I always talk about how inventory chases mortgage rates. And we are seeing an increase in home inventory. However, what we're not seeing is an increase in the number of new homes coming onto the market. So, January, February, March, we saw pretty good increases month over month. The month of February, we actually had fewer homes added to the listing inventory, but yet we're still continuing to increase our number of homes for sale. And this is because of a couple of things. It's one thing it's not due to is the number of homes in current pending status. We had 1,343 homes that went under contract last month, which is more than the previous month, but yet we're still increasing our inventory. And some of that has to do potentially with the fact that our back on market rate is hovering right around that 19%. So we had 256 homes sales that fell through last month that came back on the market. Now those are opportunities for home buyers that maybe missed those houses, And sometimes the home sales fall apart due to, maybe an inspection issue, maybe appraisal issues. We don't know what those reasons are, but that is an opportunity for 2 out of 10 home buyers out there were able to, basically come back out and basically buy maybe a house that was under contract before that they might have missed out on. One thing that's kind of interesting, you can see that we're hovering pretty close to where we were last year during the spring and summer months, right around that count number. Now our bomb rate is based on the number of homes actually going under contract. So if that goes up, the pendings go up, and this number stays steady, that just means that fewer of those home sales are actually falling apart. So we would see that down here in this bomb rate. As far as closed months or closed sales for the month, again, as typical, we're seeing the spring market now, this number rise, and this is basically built on the past 60 to 90 days of business. And you can see that, January, February was down a little bit, and that's probably because of the weather that we had in early January. But then the market kind of picked back up, and we kind of saw a nice increase in March and April. Um, but where we typically see the most number of homes closed in a month's period is coming up in June. So we would naturally expect, by looking at the historical numbers here, we would naturally expect that May is going to have more homes closed per month than the month of April. And I think we're going to be on track for that. The question is going to be is when we peak, how fast does this fall off? That's going to be a real sign of, where the buyer's appetite is out there. And I think with, if we don't see a drop in mortgage interest rates, that might be an indication that we might see this drop off a little bit quicker. One thing that we are seeing that's a little bit different than previous years is we're seeing the median sale price drop. It's down $2,500 from the previous month. And what's interesting, if you see the little black tick marks here, that means that these are the sale prices from a year ago, and we saw that February, March, and April, all the way May and even June, we saw 4 or 5 months in a row of pretty steady increases in that median sale price, and we're not seeing that this year. We're seeing a little bit of a drop, and I wouldn't say that prices are coming down, but they're just not going up. Which if you say, well, what's the difference? Well, it's just the pace of the market. We're on track with 13 days average days on market, and a year ago we were around 7 days. So we're homes are staying on the market a little bit longer, and that's one of the other reasons why we're seeing that inventory start to build a little bit, because they're just not selling at the same pace. We're selling several homes, it's just they're not selling at that same fast pace that we've seen in the past. So another indicator that might give us an idea of why that pricing is coming down a little bit is you can see here that we've seen a large number of price reductions so far this year. And you look at that and you go, well, what does that mean compared to last year? Well, I'll go ahead and overlay where our reduced properties were in 2023, and we're about a third more homes this past month actually went that actually had a price reduction. I don't know how much that price reduction was. I didn't do that analysis, but we are seeing, about a third more. The previous months weren't too far off of the previous year, but boy, this month in April, we saw quite a few more price reductions. So we'll watch that in April as well and see if that changes there. The last slide of the deck here today of the show is the months of inventory. And if you remember last week, I was talking about, if we were, what would it take to get us into between a 4 and 6 months inventory, which is a balanced market. And it really would take about 2,500 homes added to the marketplace. And, we're seeing more and more homes come on the market, but boy, if every realtor out there, like I said last week, would add one new listing to the inventory that's under $400,000, this whole graphic here would switch over. We're pretty close to it here in the 5 to 600, even the 4 to 500. We're at 3.5 months of inventory. But boy, if we could get this inventory levels built up here, I think that would do wonders for our market, because this is where all the action has to start. We have to have that low inventory, that low price point, excuse me, that low price point has to start to come onto the market and allow the move up buyers to basically start the moving up of that inventory. And if we did that, especially in the lowest price points, these price points above would all just take care of themselves. So, as you can see, we're, all but three of our price points are in that yellow sellers market, which is 0 to 4 months inventory. The most balanced market we have is that seven to $800,000 price point, and it's even at the high end of the balanced market. So it could easily be next week or even tomorrow. Could even actually be into a buyer's market like these two price points are as well. So anyway, that's kind of the show this week. Next week, I will be back from Washington, D.C. We will be talking a little bit about what Dr. Lawrence Yun has said and what's happening nationally, but then also catch back up with what happened in the local real estate market. So with that said, thanks again for joining me. Go to DesMoinesMarketValues.com. You can see all the show graphics from this week's show and previous week's shows, as well as all the previous videos. So I'll talk to you again next week. Be safe, and we'll see you all again next Sunday.